Hello guys. So the first thing I want to welcome you guys to is credit control, and we're going to talk about credit. We're going to go over all of the credit, but today we're going to talk about finance. Because when we think about finances, we think about money. Let's talk about US currency in circulation is at a level of $234 trillion. To check, we can use Google search and see that ycharts.com is a non-government website that lists currency circulation. So yeah, understand that. This means that we have a lot of financial opportunities available to us. Now, let's dive into discovering more about it through credit. We're going to see finances of credit, and we're going to reference the University of California. What is credit? Credit is the ability of the consumer to acquire goods or services prior to payment with the faith that the payment will be made in the future. In many instances, borrowing incurs fees. These fees can include interest charges, transaction fees, and penalties for late payments. It's important to carefully read and understand the terms and conditions of any borrowing arrangement to avoid unexpected costs. Now the point I want to make here is that we see the term in most cases, so not all fees are instant and some fees can help delay payment even longer. So understanding the finances of credit is more of a delayed payment. With that said, you're going to find out there's a huge amount of benefits to it. Especially when it comes to the next explanation from Investopedia, which I do like this one. What are some examples of financial credit? There are many different forms of credit. Common examples include car loans, mortgages, personal loans, and lines of credit. Essentially, when the bank or other financial institution makes a loan, it credits money to the borrower. You must pay it back on a future date. What are the 4 basic elements of credit? Credit is part of your financial power. It helps you to get the things you need now. Like a loan for a car or a credit card, basically. Based on your promise to pay later. Again, pay later. Working to improve your credit helps ensure you qualify for loans. Now, you will be involved with some loans if you buy a house, of course. You're going to be on a loan and for certain car purchases. What you're going to learn here is that credit cards will be the biggest part of your expenditures. We're done with financing and credit. So you have learned about it. Credit is part of finance. But what I'm going to talk about here is from ftc.gov Business Guidance, Credit Finance. In Business Guidance and in the Credit and Finance section, we can read about credit and loan practices for business lending. Are you up on the rules and laws that apply to your fitness for resources related to fair debt collection practices? As it reads, if you extend credit to consumers or are in the business of offering loans or helping companies that do, know your compliance responsibility. All of the headings are reference points to how business lends and reports on your borrowing habits. So, of course, credit and loans are at the top and the other ones are debt, debt collection, fintech, mortgages, payments and billing. So, a credit loan is not the same thing as credit in the traditional sense, as it is a one-time payment to the borrower. It does still involve the borrower's creditworthiness. And, if the borrower makes all of their payments on time, it can help to improve their credit score. It is a delayed payment, but does have varying loan types and fee structures. So, debt in its initial form can be a one-time payment or revolving. Debt occurs when you use any one of these or both, loans and credits. And most of the time, we use both of those. So this is most likely related to payments and will show on our credit report as payment history. But like flipping a coin, we then have debt collection, which is also on your credit report. It is when you don't pay something on time. So, you can say, if you miss a payment for 30 days, that is bad debt. So, you were assigned debt, and you missed it. And you didn't pay for 30 days. Bad debt will go as a strike on your credit report and, in some cases, go to debt collection through an agency. Now, let's look at payments and billings. Under the law, businesses must take steps to ensure that charges to consumer credit cards and cards on bills and other accounts are authorized. These can show up on credit reports surprisingly, and the most common are cell phone bills. It doesn't come in the form of payment and billing. It only comes in the form of a debt collection. It's a write-off payment that can go to public records, or it can just be put on your credit report as a debt collection through an agency. So understand those things. And those are the major financial things. So, 1. Credit and loans. 2. Debt. 3. Debt collection. 4. Payments and billing. And 4 is generally called derogatory marks in the form of public records, charge-offs, or something close to those two. Don't forget to like or subscribe to the Credit Control channel.